credit rating or credit score reflects the ability of an individual or an organization to pay off its debts, to meet its financial obligations, its financial commitments. It really reflects how risky the individual or the corporation or the sovereign state is. The better the credit rating, the better interest rate that person gets from a lender because they reflect less risk. So for personal credit ratings, often called credit scores, in the United States, they use a system called FICO. And FICO goes from 300 to 850 in scores. If you have a credit rating above 670, you're a good bet. Your credit rating is good, therefore you will pay less interest on that car loan that you want. In Canada, the credit rating, the system goes from 300 to 900, follows a similar system where 650 is the magic middle number. In the UK, a credit score goes from 0 to 999, and anything above 881 is considered to be good. In all of these cases, the companies that assign credit ratings, they're private companies, Equifax, Experian, TransUnion. And so people banks and other people who want to know buy into the system in order to be able to get information on you. If you're 18 years or older and you've started, if you have a credit card or if you've taken out a loan, you have a credit score. It pays to keep that credit score good, because if you do, you'll keep the interest rates low on the next thing that you do. So how do you keep your credit score good? Well, there are different factors. There are different factors. One factor is called your payment history. How good is your payment history? Have you paid things off? That's 35% of what they consider. It's the highest amount. The next part are the amounts you owe. So if you have a $10,000 credit card and you owe always $9,900, that actually hurts your credit rating because they think you're always at your limit. What you want to do is keep it much lower than that. Keep it below, it depends on the company, but keep it below 50% or so, and you're fine. That's 30% of your credit rating. 15% of your credit rating is the length of your credit history. How long have you had credit card? How long have you been taking out car loans, a mortgage, and so on? 15%. 10% is based on, new credit, new accounts. If it's new credit, new account, they want to treat that with a little more trepidation. It sees as a little more risky. So 10% of that, of your credit rating, comes from that. And then 10% also comes from the type of credit that you have had in the past. Your mortgage, is it a mortgage? Is it a car loan? Is it a credit card? Have you taken out a loan for that yacht? Something along those lines. So that's personal credit score, personal credit rating. Then there's also corporate credit and sovereign credit. And these are pretty much the same. How this works is this. It starts with AAA and goes down to CCC, depending on the company. There are three companies, big companies, involved. One is Standard & Poor's, another is Moody's, another is Fitch. All private companies, and all, again, people buy, they pay a membership to be able to get information from these folks. If you have anything double B or lower, it's really not considered investment grade. In fact, it's often called junk bonds. You want to keep, as a country or as a business, your credit rating in the AAA, AA, A region. It means that when you go out and you issue a bond in the market, it means that the credit, you will have a better chance to get better interest rates and so on. Don't want to go too much into that. We will later. Finally, it really just comes down to this. Keep your credit rating high, and you will be able to borrow money and be trusted better in the future.